Hello and welcome back. This is Christopher Aaron. This is Precious Metals Intelligence Plus. It is Thursday, October 16th, 2025, and I hope you are well. We are living through history right in front of our eyes. At the rate that gold is advancing now and over the last several weeks, gold is rising by about $50 per day, per trading day, and that rate of increase is actually accelerating. The percentage gain is growing day after day. At the current rate that gold is moving, if we were to fast forward just 10 weeks, just to the end of this calendar year, the end of 2025, at the current rate, gold will be trading at 7,000 if this continues. Silver has broken above 50, and it has held that for 4 trading days now. This is good to see for the silver market. However, I expect that if the near vertical trajectory in gold were to break in the near future, it's a question of when does it break? Does it break at 4,200? Does it break at 4,500? Does it break at 5,000? Does it break at 6,000? Does it break at 7,000 in December? But when it breaks, when that parabolic trajectory breaks, the first significant support for gold is not going to be until 3,300. And that's an intermediate support only. Below that, 2,900. So it doesn't matter how high gold goes right now. That support is not being built in the current gold market. Gold is moving parabolically. It can continue to do so. Don't get me wrong. But just because a market continues to move higher parabolically does not mean that the significant support is moving higher with it. Now, this is a really tricky scenario here. This is, in fact, the most difficult moment that I have experienced in these markets since 2011, for sure, the last major top. Possibly the only other more difficult moment in these markets was the crash of 2008, in which everything crashed together. This is the most difficult moment that I've experienced in these markets because there are only 2 possibilities for the gold market right now, and by extension, the rest of the precious metals. One is that the parabola continues, that the near vertical trajectory gets even more and more extreme. As I said, over the next 2 to 3 months, we'd be talking about 7,000 gold. The other alternative is that the parabola breaks and it crashes back down to about 3,000 from here. And so if it took 3 months to go from 3,000 to 4,000, I would expect it might take only 3 weeks to fall back from 4,000 to 3,000. Typically, when these parabolas break, they will come back down a lot quicker than they went up. So this is one of the trickiest moments that I've experienced in these markets in many, many years, especially because we have silver flashing this breakout, this not just a short-term breakout, a multi-generational breakout, 45 years in the making, right? And if that were to sustain, and eventually we're looking at silver hitting the triple digits, but the question is it just going to do it now in this parabolic move and just continue going vertically? Or is it going to do it in a more healthy manner, a more healthy sort of stair-step fashion, over the course of the next 3 to 5 years? That's the question in front of us. The important thing to remember at this time is that no one, not myself, not any single human being, will get this 100% right. No one will. Not yourself, not me, not anyone. So we need to banish the idea that we or anyone is going to get this perfectly. When a market is moving parabolically, these things can extend longer and higher than anyone can possibly fathom. And then at the moment where it just seems like it can never stop, the market can crash right in front of your eyes and wipe out the majority of the parabolic gain in a very, very short period of time, almost without any warning whatsoever. So this market is setting up for a dramatic series of events. And I want to come back to saying again, no one will get this perfect. But what we can do is we can make prudent decisions at key levels. We can make prudent decisions when the charts tell us to be cautious, at least. And then if we get continuation signals where the market says, yes, we should be cautious, but we're going to keep going higher anyway, we can come back into the market, but with less exposure. That's the key. As parabolic markets work their way higher, the key is to have less exposure throughout time, not more exposure. The way most people lose all of their money, I've heard this time and time and time again. Whether you're talking about the NASDAQ bubble back in the year 2000s, I know people that made millions of dollars on paper and then lost it all after the crash happened in the year 2000. Whether we're talking about that, whether we're talking about after the 2011 peak in gold, whether we're talking about the real estate mania that happened in the mid-2000s, the oil mania in 2008, I've seen it over and over and over again. And one of the lessons that I've learned is since we can't call, no human being can call the exact top of these parabolic moves. But what we can do is we can lessen our exposure as the market continues to move higher. And yes, it's difficult over the short run because then you see the market going higher and higher and higher and higher, and it just looks like you're being left in the dust and it will never stop. And then all of a sudden, there comes the day when the market reverses and everyone panics and everyone tries to get out at the exact same moment. And a short-term crash leads to a longer crash, and then a bear market follows after that. And you'll be wishing yourself that you'd taken some exposure off throughout the parabola, because once the parabola breaks, it just does not give a moment to actually do that once it breaks. And it's difficult to imagine while it's happening. So this is where we are. This is going to be a dramatic window ahead of us over the course of the next several months. And then if my reading on the charts is correct, the final wave in these precious metals markets should be within the next 1 to 3 years. And things could get even more dramatic than they are right now, actually by several orders of magnitude. So strap yourself in. Don't expect to get every twist and turn right. Try to capture the majority of the move in the middle when it's most obvious, and then think about taking chips off the table when things start to get really, really crazy. Please do not redistribute this research. Thank you for that. And please make note of our legal disclaimer for one moment. We will cover the following topics in this issue. Major focus. Dow to gold ratio, gold to real estate ratio. I haven't talked about this in quite some time, but it is time to talk about it. I have a lot of clients, some of whom are you listening to this, some other clients that I work with via consultation who have told me they're waiting to purchase real estate. Take a look at the chart when we get there. Member question, really important, silver spot price versus the futures price. I think almost everyone is getting this wrong out there, other analysts out there. And I want to show you what I have found on that. You can always find the bottom line in our current investment summary, reprinted for your convenience in the PDF file in the member section. The bottom line this week, Dow to gold ratio down to 1099, is below the April tariff bottom. So here we go with mixed signals, right? I said we're in a parabolic move higher. This can continue, but at some point it will not sustain itself. How can that be the case if the Dow to gold ratio has just taken out the April tariff bottom here at 11.15, suggesting a generational trend change is in favor for the precious metals? How can that be true? How can both things be true? Gold itself up to $4,207 in the spot market as of the Wednesday close in New York. Remember, if it's underlined, it is new from last week. Gold has achieved all of our outstanding targets. It is within a parabolic advance. Following a parabolic advance, one of either two things are going to happen, both of which will be equally dramatic. So get ready. This is not going to end subtly. Either A, gold is going to continue advancing parabolically or near vertically towards 7,000 to 8,000 within 2 to 3 months. I have not taken any new drugs today. I have not smoked anything. This is the same Christopher Aaron that has been bringing you logical and chart-based data for the last 10 years. And this is what I'm putting down on paper. If the parabola is to continue, we'll be looking at 7,000 to 8,000 by the end of the year. If that doesn't happen, the equally dramatic is going to be a crash back down close to 3,000 or slightly below 3,000, which will be the start of a multi-year top. I don't know which one I hope for at this point. Part of me is thinking maybe I'll sacrifice myself. Maybe I'll be the... You ever get the feeling like the market is waiting for you specifically to buy back in or to increase your exposure before it crashes? Maybe I'll be the sacrificial lamb and buy some gold and silver call options today, sacrifice part of my portfolio so then the market can stop moving parabolically and crash back down to a more reasonable level, and then we can look at good entry points again. So I'll think about doing that for all the rest of your benefit. So then the market can crash. But I mean, these are the possibilities here. There's not going to be an in-between possibility. There's not going to be, gold just hovers at 4,000, for the next couple years and consolidates. That's not how parabolic moves end. Silver up to $52.97 in the spot market. Incredible. Has achieved all the outstanding targets and has witnessed an initial break above 45-year resistance at the $50 level. Incredible. That said, warnings continue to suggest that silver may not sustain 50 on this attempt. If it fails to hold, a multi-year top will form, and I continue to say that the first initial support is all the way down at $40.70 and rising. However, significant support is not down here, 28 to 35. And this support is really not rising in time. So, it doesn't matter how high silver goes. I mean, silver could go to 55, 60, 65. I don't think 50 is going to act as support. Not when the market is moving vertically to slice through it. If the market was moving in a stair-step fashion and building a base up to 50 and then broke through 50, yes, then 50 would act as support. But when it's moving near vertically through a resistance like that, it's telling you that that level is basically not there anymore. And so then it's a question, what happens after the parabola breaks? Back down to 28.35 is my best guess. GDX up to 81.47 from 79.15. Everything has been achieved. There's nothing more that I can say. It can just continue to levitate. We will look in a moment, though, how the gold and silver miners are continuing to underperform the metals here, which does suggest that a multi-year top is setting up. That's the type of behavior, into a parabola in the metals themselves. We would expect mining investors to be recognizing that and sort of quietly heading for the exits as the acceleration continues in the metals themselves. And I think that's what we're seeing. Wait till you see the charts on the miners. US dollar just slightly higher when we're talking about the index itself. But it really looks like the dollar has solidified a bottom. And if the dollar has bottomed, it makes me think that the metals are going to correct here. We're sort of in that Wile E. Coyote moment, the Roadrunner and the Coyote, the cartoons, where the Coyote is over the edge already, but he hasn't fallen yet. He's looking down and he's like, wait a minute, is this actually going to... And it's like, yeah, the dollar really looks like it's already bottomed, but the metals themselves are sort of doing their own thing until, who knows, until momentum in the dollar picks up, until the metals actually realize, until the momentum-based investors start to exit, and then people start to pay attention to the dollar again. We'll see. We'll see what it's going to be. The global asset comparison for the week. Here we go. Gold and silver leading the way. Look at that. 8.5% up for silver in 1 week. Gold at 4%. I mean, great moves in the metals themselves. I'm not going to say those are not good moves. I just do want to point your attention here for a moment to the fact that the miners continue to underperform their respective metals. And this is not just at any junction. I mean, this is when silver has just broken out to a new 45-year high. 8% on the metal itself. I mean, the silver miners should have been 2 to 3 times this up. They should have been, 18 to 25% higher. They were not. They were 5% higher for the week. So clearly the silver mining investors are not convinced that this is going to stick yet. And I would say the same thing for the gold mining investors here. Let's remember that. Dow itself lower, so there's the big divide between gold and Dow. I mean, it's good to see. Wait till we get to the Dow to gold. Of course, we're talking, again, isn't it interesting that we're talking about a 45-year breakdown in the Dow to gold at the exact same moment as a 45-year break up in the silver price? Either both of those things are going to be correct or they're both false moves happening right now in front of our eyes. Next several weeks will tell. Notice Bitcoin. Look at the divergence between the speculative end of the precious metals sector and the other speculative form of anti-fiat thesis in Bitcoin. Couldn't be more clear to see that divide here over the last week. Let's switch over to the Dow to gold ratio. Okay, live charts now. This is all live, and we're looking at the 125-year perspective on the Dow to gold ratio, late 1800s through the present. And we are remembering that we are talking about something that is generationally significant here in front of our eyes. What we're looking at here is apparently, if this proves to hold, the fourth, we're going to call it 1, 2, 3, 4. The fourth is this double, slightly expanding magenta. But this is going to be the fourth major breakdown in the Dow to gold ratio in the last 125 years. The first one was 1930. This was the prelude to the Great Depression. This was stocks crashing by 90% in 3 years and gold eventually being revalued higher by 75% officially. The second breakdown was right here in 1968. This was the prelude to Nixon abolishing the gold standard with the dollar, and gold moving from 35 per ounce to 850 per ounce 12 years later. A decline of 96% in real terms for the stock market compared to gold. The third signal was right here in 2002, which led to nearly a 10-year move lower in the Dow to gold. We can argue that this third signal was really a prelude to the signal that we're seeing right now, since both of these signals basically start functionally at the same low, the 1980 low. It just depends if we're talking about the absolute low here, which gets us the trend that is now breaking, or the best fit low of this more aggressive trend through 2002. That led to the bull market into the year 2011. Either way, we're living through what appears to be the fourth major signal of the last 125 years. What I've drawn here, if we go back to this signal in 1968, let's focus on this for a moment. You can see the break of this trend, the trend out of the Great Depression, 1942, World War II. You can see this trend, 1940s, 1950s, 1960s, 1968. Rumblings about problems with the guns and butter, Vietnam War, and all the social programs, rumblings that the United States would not be able to pay its debts in the mid-60s and late 60s. What? Causing this ratio to break. And then notice that the break here in 1968 led to then what? Basically a topping process. Actually, from 1968, if we look at the blue, notice the blue lines here, notice this parallel channel, which then broke right here in 1972. So notice from 1968 to 1972, that was 4 years after the generational trend was broken. 4 more years until what? Boom, this Dow to gold ratio really started to compress lower. We can see then the retest right here. Look at this perfect retest of the blue parallel channel right here at 16 and a half on the ratio. What? Leading to the major breakdown from 16, 17 down to 1 on the Dow to gold ratio in 8 years. So if we zoom back out and remember now all the cycles that we're talking about, the difference between this 70s cycle is that we had the trend break first in 1968, and then we had the break of the topping process shown in blue 4 years later, right? Present cycle that we're living through, what we are witnessing here, it's a slightly different topping process. It was taking more the shape of a wedge. But what we are witnessing here is a break of the rising trend, similar to 1968, and a break of the blue topping process. In this case, it's the wedge pattern as opposed to a parallel channel, but it's still the topping process. We are witnessing the break of both of those patterns functionally at the same moment in time. Do you see that right here? Within 2 months, we had the break right here of the absolute lows, and then 1 month later, we're seeing the break of the blue support going back to 2015. Again, back here in the 70s, there was a 4-year lag. Break the rising pattern here in magenta, and then 4 years later, this broke down. So the other thing that I want to remind you of is from a technical basis. Remember the rule. The less steep that a rising trend is, the more significant. This trend that we are witnessing break right now is the least steep of all of these generational trends. And therefore, it should be the most significant. So if you can imagine what I'm saying, so look at what the most steep trend was. It was this one here, right? 1980 through 2002. That was the most steep. The most steep is the least significant. And so what was the result of that? It was a move from 28 down to 6 on the ratio, just below 6. Approximately a 75% decline in favor of gold, in disfavor of stocks. That was the least significant move. If we talk about this move, the break right here, leading to the Great Depression, this was a 90% decline in the Dow to gold. We already talked about this break right here. This was a 96% decline. If each of these former cycles were more steep than the one that we're witnessing right now, dare I say that we are setting up for the most significant contraction in the Dow to gold ratio that has ever occurred, ever in the history of the United States? Okay, I said it. That's what the charts are suggesting to us, and that simultaneous break of the blue concurrent with the magenta being even more dramatic than the break that we saw back in the 60s. That adds further weight to that process. Now, all of this, of course, presupposes that this breakdown that is currently underway, that it holds. It would be most unfortunate if this breakdown that we're witnessing here, currently at 10.94, as we get into the middle of October, it would be most unfortunate if that breakdown were to reverse and close back above 11.15 by the end of the month. That would be a significant topping signal. I take the breakdown as valid unless proven otherwise. And this is an extremely dramatic signal that we are seeing. And I'm going to give you a little foreshadowing here to say that not everything is going to match up in the storyline that is approaching for global markets. There are disparate data points that do not all fit neatly into a coherent narrative. So we're going to have to live with paradox. We're going to have to live concurrent with paradox, or concurrent with viewpoints that do not seem to match up until a cohesive narrative can present itself. This is the Dow to gold ratio, and it suggests from approximately 11 that this ratio will be moving down into the range of the former 2011 bottom over the coming months. We're talking, this should be a matter of months to get down that low, following a bounce, followed by a move back into the 2030s down toward closer to 1-to-1. And so here I want to switch over to my annotated charts, and we want to bring this up now so I can show you what I think is going to happen here as long as this breakdown holds. Current levels for reference: Dow's at 46,300. Gold is at 4,200 approximately. Remember, I have a higher target still for the Dow. I don't see a crash happening in the Dow anywhere in the foreseeable future. My higher targets are still about 15% higher for both the S&P 500 and the Dow Jones. So, from the current level, the next significant support for the Dow to gold ratio is going to be in this black band, 5.7 and 7.3. Swing lows here from 2009, 2011, and 2012. If we take the mean of 7.3 and 5.7, we get 6.5, right here in the middle of this zone. That's a significant way lower, from nearly 11 down to 6.5. There is no support on this chart until that level, 6.5. So to talk about what this should look like using the current levels, if we imagine that this is going to be an inflationary outcome, where the central banks, the Federal Reserve does not allow the stock market to decline as it probably should based on fundamental overvalued metrics. And they're just going to print money despite a recession, despite whatever's going on in the world, and they're going to bail out everything that needs to be bailed out. And so the Dow continues to rise, as I said, about another 10 or 15%. If the Dow is going to rise up to 52,000, but the Dow to gold ratio is going to decline from just below 11 to 6.5, that means gold's going to hit 8,000 here within the next several months. Remember, in the very beginning, I said 7,000. 7,000 to 8,000 is a good ballpark. This is simply how the math works out. If this ratio, if Dow is going to be 52,000 like I expect it will, and this ratio is going to compress in favor of gold, you divide 52,000 by 6.5, it gives you 8,000. 8,000 gold, perhaps by the end of this calendar year. If this is going to be more of a stagflationary type environment where, let's say, the Dow doesn't rise at all, in other words, it stays at 46.3, we would be talking about gold still rising to over 7,000. If this is going to be a deflationary scenario in which the Dow is going to crash, lose half of its value from 46.3 to 23,150, it means gold would fall nominally from just over 4,000 to back around 3,500. That would be the deflationary scenario where they allow the crash to happen and everyone floods into the US dollar and gold just falls less than everything else. Which one do I think it's going to be? Probably the inflationary or the stagflationary scenario here within the next several months. Oh my God, I can't believe that I actually said that. But yes, as long as this Dow to gold ratio holds below 11.15, the last swing low here from April from the Trump tariffs, my expectation is that within the next several months, gold will achieve $7,000 to $8,000. From there, I would expect a bounce. So can we imagine in the Dow to gold ratio, can we imagine the parabola continues in gold for the next several months? Gold gets to around 7,000 or 8,000. And from there, it corrects from 8,000 back down to 4,000. Gold loses half of its value. I told you, parabolas are not going to end neatly. They're not going to end concisely. They're not going to end with just a gentle little rollover and a plateau. They're going to end dramatically. That would constitute a retest of the blue wedge right here. Gold back down to 4,000, followed by what? Rolling over. The retest should fail. The message of a generational trend break right here, combined with a wedge breakdown, would be that this ratio is going to eventually move what? Back down, below 6.5, there's really no long-term support until the 1980 lows. In the inflationary scenario, where the stock market, the Dow, which is currently at 46.3, let's imagine that the stock market doubles over the next decade as inflation gets worse and worse and worse. We can imagine the stock market doubling. If the stock market doubles and the Dow to gold ratio is going to go to 1:1, it means gold will achieve $92,600 per ounce sometime in the early to mid 2030s. Yeah, I put that down. I put that down on paper. That is the inflationary scenario. Now, I can't guarantee it's going to be the inflationary scenario. If it was going to be the stagflationary scenario in which the Dow doesn't change at all, but the model holds, we break 6.5 a few years from now and then continue back down to the 1980 low, we'll be talking Dow at 46,000, gold at 46,000. Let's imagine that somehow the Federal Reserve decides to, they find religion, so to speak, and they do not print money. And, politicians allow 90% of the businesses in the United States to fail, and they allow home values to collapse, and they allow the government to default outright on its debt. The deflationary scenario, in other words, the Dow falling by 90%, which is what happened in the Great Depression, from 46,000 down to 4,000, would see gold basically hold its value in that instance, not change in nominal terms, but you'd be able to buy 10 times more Dow shares with the same ounce of gold. Do you see that each of these scenarios are functionally the same? It's the same net gain in purchasing power for gold, basically an 11x from 1 to 11 where we are now. It's just we're talking about outright inflation, stagflation, or deflation. Which will it be? I can't answer that question. I suspect it'll be somewhere in the middle. Somewhere in the middle. Can we imagine the Dow falling back down to 20,000 and gold rising to 20,000? Somewhere in there. But this is, as long as this breakdown holds right here that we are witnessing now, and it's no longer imaginary, it's no longer hypothetical, we have seen the initial break. What it needs to do now, because we're looking at a multi-generational chart here, it needs to hold. It needs to hold here below 11.15. It would be most unfortunate for this ratio to have printed this lower low down to 1095 and then reverse, tomorrow or next week. That would constitute what? Again, a false breakdown. We do not want to see a false breakdown. I tend to, in technical analysis, I tend to take the breakdown to be legitimate unless proven otherwise. And so these become our official scenarios unless proven otherwise. Extremely dramatic scenarios that are our official models unless proven otherwise. Now remember that I said that everything is not going to align neatly in a cohesive narrative here, because this is the Dow to gold ratio. What I want to do next is switch over and look at gold versus real estate. Gold versus real estate, equal time comparison. We're looking at just over 100 years. So we have good comparisons. Dow to gold and real estate to gold. Here we're looking at the Case-Shiller Home Price Index divided by gold. And just to make this really obvious so we're all on the same page here, the higher that this goes, houses are expensive and gold is cheap. The lower that this goes, houses are cheap and gold is expensive. So in other words, this ratio is showing us how many ounces of gold it takes to buy the median house in the United States. Both of these are real assets. Both houses, especially the land that goes underneath the house in livable areas, let's say. The houses, the land, and gold are all real assets that can't be printed out of thin air. They can't create any more land. They can't create any more gold out of thin air. Both of those, housing supply and gold tend to increase proportionate with the population throughout time. So there's a natural counterbalance to increases in supply. Both are real assets. It would make sense that there is a relationship between real assets throughout time. There is, but we can see that the ratio oscillates quite dramatically even within that boundary. So all I want to do is point you to the current level here, which is approximately 100. It takes approximately 100 ounces of gold to buy the median U.S. home. Median U.S. home is just above $400,000, and gold is just above $4,000. So 100 ounces of gold to buy the median U.S. single-family home right now. And I want to take you back and remind you that this level, think about this for a moment, is actually only half the price that houses got to in what? The Great Depression. Less than half the price. Can you believe that? So you can buy 2 times as many houses for your gold now, or twice the amount of house, or the same house would be less than half the price compared to what? The greatest depression in the history of the United States. Isn't that interesting? Not only that, but the current level at 100 approximately matches here what we know in retrospect to have been a temporary bubble level for for gold in the United States. The 1980 peak, we know that was a bubble peak. $850 per ounce for gold only held for about 1 week before it crashed back down to 500. But at that exact moment in 1980, with gold at 850, the average U.S. home sold for 85,000, approximately 100 ounces of gold. That was a bubble level for gold. We know that. We have retrospect. We have history to guide us. We are at the same level right now in the comparison between these two real assets that cannot be printed out of thin air. We're at the same level as a bubble in the year 1980. This is a caution. This is a significant caution. Finally, we are at approximately the same level that was achieved in the year 2011 when gold peaked just below 2,000 and the average U.S. home price was just above 200,000. So we have these 4 data points. I mean, back here in the Great Depression, gold was at a fixed price and then it got revalued. But we can see home prices fell by 40-50%, and then gold was revalued for this decline to happen. But here, and presently, we're talking about freely traded gold and freely traded houses to some extent. Yes, there's government interference in all markets, including the gold market and including the mortgage and real estate markets, right? Both markets, all markets are interfered with or manipulated. But a ratio between real asset classes cannot go to zero. And we are currently at this level, which says that gold is the most expensive that it has ever been, and houses the cheapest that they have ever been in this comparison. From the current level, if this ratio is going to get back to where it was in the year 2000, or even, yes, this was a manipulated figure with gold held at 35, but we can talk about all these levels. Look in here, 1950s, 1960s, 1970s, right? Matching fairly closely with the 2001 peak. If this ratio is going to move from where it is at 100 ounces of gold back up to these peaks, it would mean that the average house multiplies by 7.5-fold without gold changing $1 from where it is today. So can you imagine the average home price moving from 400,000, or the median home price moving from just above 400,000, 7.5-fold? We're talking close to $3 million for the median U.S. home price with gold not changing. That's what would happen if this ratio was to get back to the previous peaks. The other way that this ratio could get back to the previous peaks would be by gold to fall by 85% from the current level, with house prices not changing at all. So, remember I said the story is not going to be cohesive at this moment in time. We need to live in a state that does not have closure to it right now, where the story is not written, where there are X factors. How can it be that gold is breaking down or breaking out versus the Dow Jones with an expectation to rise 11-fold versus the Dow Jones, at the same time that gold is overvalued or at historical extremes versus real estate. How could gold gain 10 or 11-fold versus the Dow at the same time that houses gain 7-fold versus gold? That would mean that houses are approximately 70 times 70 undervalued versus the Dow. I know. The things that I'm saying today sound insane. Once again, I am the same Christopher Aaron, but these are how stretched the ratios are, and I'm trying to put together all the pieces, and I'm trying to make you aware of the extreme nature of what we are living through right now. Are we to suppose that we're going to enter a new paradigm here where this ratio breaks down below 100 and maybe falls to 50 or 25 or 10 ounces of gold to buy the median U.S. house? I mean, if gold went to 40,000 and house prices stayed where they are today at 400,000, that would be 10 ounces of gold. But that's a huge assumption on our part. Outlandish, if you ask me, to propose that a ratio between real assets, both of which serve as inflation hedges throughout long spans of history, that this ratio is going to break a 100-year range. So how can it be? How can it be that gold is going to outpace the Dow over the years ahead, yet houses are going to outpace gold over the years ahead? I did not say that I had all the answers, but I do hope that by illustrating these extremes to you, I at least get you to think and at least get you to step back from the FOMO and step back from the intensity of the groupthink that currently permeates throughout the precious metals only community, the community that thinks that gold can only go higher. I think that gold can go higher, but there are some question marks here about how this actually happens. And as thinking individuals, we must consider the X factor. We must consider the scenario that lies outside of our comfort zone. How can these things happen at the same time? I mean, just as a final thought, one way that I can imagine this happening is, for example, if they allowed the Dow Jones to crash versus gold. So let's say gold doubles from here over the coming years, and the Dow loses half of its value. And as gold is doubling, let's say real estate prices triple or quadruple. So somehow, even though gold is outpacing the Dow, real estate is outpacing gold concurrently. That's a scenario that I could foresee. The problem is that in the world that we live in, we see how unwilling central banks or world governments are to let stock prices crash, and they'll basically print as much money as they need. Yes, there can be temporary crashes, but we know they'll fill in all the holes with as much paper as they need to. So it makes me wonder if we get the inflationary outcome or the stagflationary outcome as the Dow stays even and gold rises over the years ahead, do we not see real estate rising more than gold in percentage terms over the same period of time? Member questions. I'm going to pull up the exact email here that was sent to me from Ali, and I have blocked out your last name and your email address so we can maintain privacy here. But I had a number of people asking about this, and so I felt this was a good one to just answer. So his email says, first, I want to thank you for your analysis. Thank you, Ali, for saying that. I appreciate your message here. I've noticed something unusual in the attached chart that caught my attention. The difference between silver spot and futures prices is about to close at a historic level not seen since 1980. Based on your experience in this metals market, what could this indicate? Is this a signal or metric that you personally take into account when evaluating silver's long-term trend? Looking forward to your thoughts on this rare setup. Again, thank you for the message. And a number of people sent this question in. I'm just choosing one email to show here. And also, I have seen this being posted, this theme, all over the internet right now. This is being talked about in podcasts, on X, Twitter, YouTube, everywhere in the silver community. And so just to show you what I'm talking about here, I'll just pull up a few examples of some random people on the internet. Just Dario says spot silver is already back above 50. Spreading with futures is now 5%. This is the threshold when the link between physical and paper breaks. Interesting. I've been hearing this for about 20 years. Get ready for incredible things to happen all of a sudden, especially if requests for physical delivery start climbing fast. Okay. So we had 373,000 people see this. What else here? I've never seen this level of backwardation in the futures market. Something is finally broken when spot silver is at 50 and the December futures contract is at 48. Better get your physical in your possession or your own producers with reserves, but the market is telling the futures markets are broken. Okay, let's see if this is right. Just one more example here. Silver spot futures versus spread, 225, highest ever. So, I'm just bringing this up to show you that, basically the universal belief in the silver community right now, from what I can observe, is that this is the highest spread ever, that this has never happened before, that the physical and paper markets have finally broken. Again, this sort of, it's similar to like that sentiment that we saw a few weeks ago of everyone saying, this is the moment when silver's 45-year pattern breaks. Like, it's guaranteed. Nothing can go wrong with that scenario. Everyone's pretty much believing this. Well, for all those people, and Ali, I'm not blaming you at all because I suspect you're reading a lot of those people. Here's again where I'm going to come out and I'm going to say almost everyone is wrong. And why are they wrong? I think most of these analysts do not do enough research. They do not pull their charts back far enough, or they do not interpret the data correctly. I'm going to flat out say that. I think most people interpret it incorrectly, and I do pride myself on at least trying to look at the most comprehensive data set possible and try to really look at it with a critical eye. I've noticed a lot of those people just, I'm not talking about you, Ali, but a lot of the people that posted those things on X or Twitter, they didn't go all the way back to the year 1970. We should always do that when we're talking about extreme things. They also didn't overlay that top chart with the actual silver chart, like to say, hey, how rare is this kind of thing? And what happens actually when we see the spread between the futures prices and the spot price differ so much? So first of all, let's just talk about what that means. It's typical that the spot price for silver, which is current to the closest price for the bulk commodity, is slightly lower than the futures price. Why is that? Well, because something in the future, there's storage costs associated with it. There's the interest rate calculations to take into effect. You're talking about getting something in the future. Money loses value in the future. And so the futures prices are typically higher than the spot prices. That changes on rare occasions. And yes, when it does change, it indicates that there is tightness in the physical market, that people want silver now compared to wanting it in the future. That is relatively rare. However, the tricky point that most of those other analysts did not look at is, does that signal actually coincide with a powerful continuation move higher? Or does tightness in the physical market actually coincide more often with a top? Paradoxically, hard to believe, could it be that when there's high demand for the physical in coin and bar form, that could be more of a signal of, let's say, FOMO, or let's say, unsustainable speculation. Let's take a look at the full scope of the data here. Let's go back to the very first time. Here's the current level. You can see the dashed line right here. 1.06 is the level that's just get hit. By the way, it's already come back to 1.01. So it's already fallen back quite dramatically here in just the last week. But the level that was just hit 1 week ago, 1.06, let's look back at all the times in which that level was hit over the last 50 years. Look at this here. The first time that that level was ever hit was right here in 1974. What happened after that? Yes, if we fast forward 5 years later, there was a powerful continuation. But when this level was hit, in other words, when the spot market overtook the futures market, which is called backwardation, this actually represented a 4-year peak. 1974, it took until 1978, actually, for silver to overcome that peak. So that was a 4-year peak. And furthermore, the price of silver fell. It's hard to see here. It fell by 35%. And so indeed, when there was tightness in the spot market, in the physical market, by the hot money, by the investor that had ignored silver for so many years and suddenly said, give me coins, give me bars, that represented a top, not a bottom. Let's look at the next signal right up here. And not only the next signal, but the most dramatic signal, the most that spot has ever had a premium above and beyond the futures. I mean, everyone was trying to point to this signal a week ago to say this was extreme. People were saying this has never been happened. This was much more dramatic. These two examples here in red, this one is the most extreme of those examples. What did this occur? The exact top in the year 1980. Can you see what I'm saying here? When people start rushing in to buy coins and bars, and there's lines around shops and dealers are sold out, that tends to represent a significant peak. In this case, a multi-decade peak for the silver price. We could see a little bit of a lesser signal here in 1982. There was decline after that, a little rebound. We can see this signal here. Okay, so finally, I mean, the fourth time that this signal appeared did represent a short-term bottom, but then the market continued to fall for another couple decades. This signal right here, so what I'm trying to show you is, right here I've shown you 1, 2, 3. These are the 3 most extreme examples that we've ever seen of the spot premium over the futures, and that also represented a top. 1986, I mean, silver didn't get back above that level till 2004. So the 3 most extreme examples were all tops. Then we have all these examples in here. Let's call it from the 90s and the late 90s, which were sort of neutral, right? I mean, you could talk about a bottom being carved out here. You could talk about this one being a short-term top. But even that, even if you were using this signal, let's say in the early 90s, I mean, from when the signal first appeared, which is actually right here, I mean, the price kind of went sideways to drifting lower, for another 12 years. So there's also opportunity cost. And what happened during this period of time, this was the roaring 90s for technology and the NASDAQ bubble. And, you would have made 10 times your money in the 90s in stocks compared to holding silver for 10 years, which did nothing. So here we have 3 out of the 4 first signals that were all topping signals. And then these signals are just grind and malaise. I mean, if silver was going to move sideways, between 40 and 50 for the next 10 years, and stocks are going to enter a new bull market, I would not want to be sitting on silver. So, we couldn't use that signal there. Okay, we finally start to get some signals here, but look, more moderate signals in the 2000s. You get tightness in the physical market. That did coincide with sort of bottoms or acceleration points in the mid-2000s. I'm not saying that can't happen. But the big difference is what? I mean, this was a bull market for silver. So really the question has to do with the overall trajectory of the market, not so much with this signal. Here we can see one more signal now that happened in 2013, right up there, basically the same level as we are at today. And that was a top for a number of years. 2012 to 2015, the bottom. So here we are today with that signal again. You know, all the casual precious metals analysts think that this is the all systems go signal. I'm just saying that the actual evidence here is far more mixed to even, I could say, a bias of being slightly negative when taken as a net sum. But back to the main point, I think when this signal appears during a bull market, yes, it is bullish, but not always, because when this signal appears at an extreme point in a bull market, it can represent a multi-year or a multi-decade top. So it depends on how extreme this point is right now that we are at, and it depends on the overall trajectory of the market. I hope to just offer some illumination here to be very, very, very careful who you're listening to, and are they showing the complete history of the signal, and are they showing all of the relevant examples, or are they just cherry picking, as we saw some of those examples the last 10 years, or even the last 30 years is insufficient. We have to look at all the signals here. Certainly a mixed bag, and not a universal bullish signal, Ali. Now I want to switch over to the live silver chart. Okay, the live silver chart, this is the perspective that we are used to seeing going back the last 50 years. Here is the breakout that we are seeing, at least the very beginning hint of. The question is this going to sustain? Is this the moment that it breaks through this 45-year resistance for good, or are we seeing a fake out type of signal? Gold is moving parabolically. Gold could continue to move parabolically. If gold continues to move parabolically, I suspect that this breakout will be legitimate. If gold corrects today, tomorrow, next week, next month, from 4,000 or 4,500, wherever it is at the time, back down to 3,000, because it's difficult to predict when these parabolas are going to break, I suspect this will be a fake breakout that we are seeing right now. And if it's a fake signal, we will be looking at support not existing until the low 30s. So this is a very, very, very tricky situation that we have on our hands. I've made the case before, and I'll say it one more time. It is exceptionally rare to see markets break out on their third attempts. Not only that, but the way that silver is breaking out is just not ideal. This near vertical attempt to break out, I would have much preferred to see this type of stair step pattern here for the next 1 or 2 years, and then some nice quiet consolidation, let's say between 45 and 50, lasting 6 months, 12 months, basically lulling everyone to sleep again, and then getting a breakout. That would have been much preferable. What we're seeing right now is not ideal. That said, this could be it. We're going to have to give it some time. With the majority of the mixed signals that we're seeing here, the dollar trying to bottom, the metals themselves in parabolas, Dow to gold ratio is a 45-year breakdown. We need to give that some time. The gold to silver ratio, we will look at it in a moment, but that has not broken lower yet. It still looks to me like the gold to silver ratio is trying to bottom, which would be a negative signal for both gold and silver. Yet we have silver breaking out on a nominal basis. We just have to give this a little time. I want to take you to the all the way super big picture. We actually have not looked at this ever here in this service going, a couple hundred years. Here it's tough to see, but there is a data point that we're looking all the way back to the U.S. Civil War right here, 1860s. This is when in the Civil War we saw that price spike in gold, and there was a price spike in silver from roughly $1.25 up to $3, nearly a tripling in the price of silver. It's difficult to see, but if you zoom in here, and if we were to change this to a line chart, there you go. You can see it right there, nearly a tripling in the price of silver. But I want to go back to the bar chart because line charts only show us monthly closing, whereas bars show us the extreme. So that's the extreme right there. And then if you just notice a lot of the lows in here in the early 1900s, we have a very nice rising channel here going back the last 200 years with this flat resistance. I do believe it is only a matter of time before this breaks out legitimately. And when it does so, we talked about an amplitude target, which is going to be $95. However, the commodities model, when we average in platinum, palladium, copper, and oil, that model getting us closer to $200. In addition to that, if I follow this trend from 1865 through 1980 and kind of extend this upward into the 2030s, where does that get us? Up here around $400 per ounce. I could see silver achieving a level like that. Remember the commodities model of a quadrupling up to 200. All those commodities were 25-year consolidations. Silver has been consolidating for 45 years, nearly twice as long. So why can't silver achieve twice as much upside if it's been consolidating for twice as long as copper or oil or platinum did at their respective breakouts? I absolutely think that it could. So the reason why I bring up this long-term chart, and I mention all those targets, 95, 195, and then possibly up to 400, is just to emphasize here, can we please give this just a few more moments? If this breakout is going to be for real, it is such a gargantuan breakout that's going to last the next 3 to 5 years, maybe even 7 to 10 years. It's such a gargantuan breakout. It's going to be so life-altering that it won't matter if we hesitate at 52, 53, 54, or 55. It won't matter because this is going to be such a life-altering move for everything related to silver. So can we please just give this a few more weeks? Can we give this a few more weeks? I want to see that consolidation in silver and everything related before we start sounding the all clear signal above $50 per ounce. Last couple points today, guys. This is how quick this could happen. If we zoom in on this right here, the move above 50, look at what happened a few days ago in the overnight hours. Silver fell by $4 in 20 minutes. It fell from 53.50 back down below 50 briefly. Literally 20 minutes. This is how quickly, if the parabola is going to break in gold, can you imagine silver falling $4, having a little recovery, and then 20 minutes later falling another $4? We're talking down $8 in an hour. And from there, the multi-year top is in. This is how quickly this can happen. Now, this $4 drop did get recovered, and we're now testing the highs again. But I'm telling you, people do not think this is possible. This is possible. What we would want to see is continued consolidation above 50. It's been 4 days. That's a good first hint, but I'm telling you, this is a 45-year breakout that is trying to happen now. We need to give this a little bit of time to be sure. There's no exact amount of time that will guarantee this, but we start to get into 2 weeks, 3 weeks above 50, starts to stack the odds. 4 weeks is really good to see, would be really good to see. But I'm telling you that $4 decline, if you can imagine that happening, and then another $4 the next day, and then another $4 the next day, that's what can happen if the market were to try to give us a false breakout here. And we just have to stay open and not get too sure of ourselves before we get confirmation of this here. And you certainly do not want to be leveraging upward. You do not want to be going all in right now on call options and levered ETFs and everything like that. That's how traders get completely wiped out if this market does do a dramatic reversal. You want to be deleveraging as the market moves higher. But please be careful here, and let's give this market just a little bit more time. Last but not least, I want to update the gold miners and the silver miners. We saw the break of this wedge pattern about a week and a half ago. The market has continued to move higher on the opposite side of the wedge for the gold miners. But I just want to point out to you here that since we saw this wedge forming, if you notice that gold itself, this is the GLD fund for intraday data, gold itself is higher by 11.5%, now above $4,000 from this point where the wedge began to form. The GDX is up 8.6%. So what this is here are investors in mining companies saying that they don't believe this move in gold. I've seen this so many times before, and it tends to happen at these extreme levels. And you have other investors piling into the miners right now saying this is it. This is the moment we go, straight higher forever. But you have selling happening behind the scenes in the miners. I mean, in a sustainable move, 11.5% in gold itself, this should be higher by 22%, 30%, something like that. So there's relative underperformance in the gold miners. And then it's even more dramatic if you look at the silver miners. We broke the wedge right there on the silver miners. Same thing, trying to claw its way higher on the opposite side of the broken wedge. But we look at the performance here since this wedge began to form. Silver itself higher by 23%. Not only a random 23%, it's a lot different. For example, if we were talking about silver moving from $10 to $12.30, that would be a 23% gain. This 23% gain is the move to break out to new all-time highs. You'd think there'd be just a ton of enthusiasm in the silver miners. The silver miners should be higher by 75% amidst this kind of move. They're not. They're only higher by a little more than half of silver's move. So clearly I'm not the only one here who is cautious. If a top was going to form, if silver was giving us a false move right now, this is how it would appear. We would see this underperformance in the silver miners, and then eventually the parabola in gold breaks and silver falls $5 or $10 in a couple days. It's back below 50, and from there it grinds its way lower back down to 30 or 35 over the coming year. I mean, this is how it would form. I know it's nearly impossible to imagine that happening when it's moving higher. I'm just saying that I've lived through so many of these cycles and I've studied them so intensely that I know the warning signs for this potential. If this move in silver is going to be for real, let's give it a few more weeks here. We have targets that are in the $100, $200, $400 range for silver over the coming years. We can afford to give it a little bit of time to sustain it and to prove it to us above 50 on silver. Coming into service soon, new position alerts if we do get the stability in silver in the sector. If we do get that, by the way, the value will be once again in the small cap silver miners, some of which, I know this is hard to believe, but because a lot of the large cap miners have had significant moves, but some of the small cap names are trading at the same level as when silver was $20 per ounce or below that. And if this breakout in silver is going to be for real, I think this is the last big picture thought that I want to leave you with today. If this breakout in silver is going to be for real, what you have to keep in the back of your mind is that this cycle in silver is not going to end. If this breakout is for real, this is not going to end with just a little move in silver to come. And this is not going to end with us talking about the underperformance in the junior silver miners. If this breakout is for real over the next 3 to 5 years, this is going to end in an outright mania. An outright mania, not only in the small gold and silver bug world, not only in the online gold and silver communities that are presently in the midst of let's call it a mini mania, but this is going to end in a mania amongst the general person in the streets, which we are very, very far away from that now. I would encourage you at this point to start making a practice over the coming weeks and months of just casually asking people that you meet in everyday life. The question that I like to ask is, the way that I like to phrase it is, hey, have you heard anything about what's going on with the silver price? Like really casually, as if you're not supposing anything, as if you're yourself a casual investor and maybe you heard something on the radio about it. And I'm starting to ask that to, like, for example, cashiers at grocery stores or my hairdresser or people that I meet at the bar or at the coffee shop. But just like that, have you heard what's going on with the silver price? Like you don't really know anything about it, but you're wondering if they heard. And just start keeping track of who is actually following this and who is not, because eventually this is going to end with similar to what we experienced in Bitcoin a few years ago, where it seemed like everyone was talking about Bitcoin. This is going to end with everyone talking about gold, silver, and gold and silver miners. Everyone. And we have not lived through anything like that so far in the cycle since that began in 2000. I mean, we can argue that was achieved in the year 1980. But 2011, we started to get some enthusiasm. I told you the story. I was having casual people asking me about gold, silver in late 2010 and early 2011. Not everyone, but it was starting to really percolate in there for a few years. We're nowhere near that now. So there are these divergent data points. We need to give silver some time here to prove itself to us. Dow to gold ratio appears to be breaking down, but we also want to give that at least a month to confirm. At the same time, the real estate to gold market is telling us that gold is overvalued or at an extreme valuation versus the average U.S. home price. How can these things go together in a world in which the Federal Reserve and governments will not allow long-term deflation to happen? How does this all fit together? Those are the big questions. Start keeping track of who is asking you about silver, who is paying attention to it, and prepare yourself, because if this is a false signal in silver, that might be bad news for the next year or two. But the good news is that it would be very rare to have a triple long-term top. And so what I believe it means is if silver is not ready right now, I think it will be ready in 2026, 2027 or so. And then we are all but guaranteed that this breakout will be for real on a fourth/fifth attempt. And then we are basically just in sit back mode, and we prepare for the mania to develop. And won't that be fascinating to live through? And I have some additional thoughts about new positions and the way that I want to construct my own portfolio here for precious metals, including physical metal, including mining sector positions. I have some new target allocations for that I want to share with you over the coming weeks. So that will be coming. Possibility of protective positions if we were to see silver fail. We did cover the spot versus the futures market, and we know that signal is not what it's being heralded to be amongst the precious metals community. I hope that is clear. Feel free to send in any questions that you would like to see covered. We have a few questions I'll try to get to within the coming weeks. My number one priority is going to be to stay on top of the macro signals. I've been through this before, and it's so easy to get caught up in the noise, all these other things that people are talking about, shortages, COMEX defaults, BRICS countries buying gold, all the stories that we hear guarantee that silver is going to break out now. Everyone's moving out of the US dollar, all these stories. And I've just learned that the most important thing that I can do with my own time, my own energy, is to focus on the macro. If we get the macro right, everything else will align. So I'm not going to be publishing with every twist and turn of the gold and silver market here. There may be a flash update if we get something dramatic. Barring that, the next update will be 1 week from now as we continue to get more clarity on these big picture signals. Thank you.